What's up, guys? Mike Sharp here. This is Sharp Investing, and this is Dollar General. Dollar General is probably everybody knows it. It's a rural, low-income focused dollar store in the US with over 19,000 locations. And as we also probably know, they got hammered on their last earnings release, down by 30% in a day, and they're down 67% from the 2002 highs. So is this a permanent impairment to the business, or is it creating a short-term opportunity for us to maybe get a quick double out of this while the situation normalizes and the new old CEO is back to try and right the ship? Before I get into it, I just want to say that most of what I'm talking about here is pulled from a write-up from C2 Capital. It is a Substack that a brilliant young analyst that I know has put up there. Now, he's very busy with university, but this guy's a genius and you should really check it out. I made a great call on Spotify a few years ago, or a few years ago at about 100, and that thing is up over 3.5 times. I have done some work with him on PDD, and I can tell you he is an up-and-coming star in the space. So check it out, subscribe, make a contribution too. I think that would help him be encouraged to do more of these write-ups. So anyway, if you like this, check that out. You'll get more information there. Okay, so the current earnings that they just released are, I wouldn't say they're abysmal, but they are below the analyst expectations. Same-store growth was 0.5%, and the forecast was 1 to 1.6. So that's not encouraging. The buybacks have stopped. The growth was 4.2%, which actually isn't terrible for a business this size, sort of like just a big retailer. The forecast for the year is 5%. Again, not terrible, but the target was for over 6%. So this is a disappointment crash. I mean, if the target was 4% and they got 4.2, it might go up. So I think this is just like, it might be just short-term emotional move, fear that worse stuff is coming. But they did lower the forecasted EPS from down to 5.5 to 6.20, which is pretty low historically for them. And the margins are the last 2 quarters have been 3.6%, which is well below the pre-COVID levels of, let's say, 9%. And post-COVID it was still up in the 6.5 range. But right now they're trading at about 14.5 times earnings. Not exactly cheap based on current earnings for a sort of a slow growth business. But I think there are some reasons to believe that this might turn around. But primarily here, this is a margin story. Can they get the margins up or not? Or are they just a 3 to 4% margin company going forward? The company is talking about the macro situation and how that's a bit of an issue, but there are a whole bunch of other stuff that lead into this, right? So they've had understaffing problems, which leads to high level of shrink or theft. The CEO last year quit. Last year he quit. The SNAP program benefits have been cut in 2023. They had big inventory write-downs, and obviously the margins are down. Plus, there's some other problems too. I think if we go by what the company says, the mid-level consumer has not come down into their range yet, right? As people have economic problems, they move down in terms of where they're shopping, and Dollar General is right at the bottom of the pile, right? Like you can't get much cheaper than that. You can buy small quantities of items for very little money, right? Which is a little bit very different from Costco. You have to buy a lot of something to get a cheap price. And even Walmart's like that too. You generally have to buy more. You can't just go in there with $1 or $2 and buy stuff, right? So they are at the bottom of the pile, and they say that their consumers are getting hammered by this cost of living problem, and they're not being supplemented by the sort of the mid-range consumers. Now, like in Canada where I am, we have a different situation, and I don't know if this is going to happen in the U.S. Because ours is primarily based on mortgages. People usually have 5-year or less mortgages in their term, and then they have a very high proportion of variable rate mortgages. So a lot of those mortgages have reset at the higher interest rates. And for example, my friend who used to pay $2,800, he just renewed like last week, and he's paying $4,800 now for the same mortgage. And so you can see that, and he's sort of upper middle class, and he's being pushed down away from the regular grocery stores into places like Walmart and Dollarama, which we have here. Side note, Dollarama, if you're checking out a lot of dollar stores, I would look at that one as well. It's a very well-run dollar store in Canada. Basically, they're destroying everyone. Just close to where I live, there's 2 dollar stores. There was Dollar Tree and Dollarama. Dollar Tree died. They took over the space. Now there's 2 Dollaramas, right? But that stock is not cheap, and I digress. Might be worth checking out in case it comes down at any point. For Dollar General, I think the upside here is, let's talk about the upside potential and the moat. So first, the moat, they are primarily in rural areas, very small towns, and they're one of the only companies that's ever been able to do this at scale, to be able to actually service these really small towns profitably. So really good supply chains and really good systems that have allowed them to do this. And the moat comes in that these, like I live in a town. I wouldn't say it's a small town like some of these Dollar General towns, but basically once you have one of something and it's servicing the population, if another company comes in, like if let's take a grocery store, right? If you have a grocery store and they do all, everybody buys from there. If you add a second grocery store, it doesn't actually increase the demand. It basically just pulls demand out of one and into the other, and both of them have problems, right? And that's what happens with a lot of businesses in small towns. Dollar General basically has, maybe it's not a moat, could be considered a moat, but I think it's basically a first mover advantage. They're the first one to be able to crack this nut, and basically, and they've also fended off Walmart from trying to hone in on their turf. So that says to me they have a pretty good foothold here, right? And like if we go outside and look at a different company, Facebook, before they were Meta, they got attacked by Google, and Google created their Google Plus. I don't even know if it's still active or not. Basically, that's a social network like Facebook, and they were trying to take market share from Facebook and failed miserably, right? Because Facebook had the network moat going, and Google just gave up, right? And that proved that they had an impenetrable moat, because the biggest company with all the Gmail addresses and all the money, they had everything at their disposal to attack Facebook, and they failed. And you could take it's not exactly on that level, but you could say if Walmart's failed to hurt them, then I don't really know who else is going to have the wherewithal to do it. Now, somebody can build a better mousetrap. Retail is notoriously competitive, and everyone's always trying to up the game. Like in China, Alibaba, they looked impenetrable for a while, and then PDD created a better mousetrap, and they came and took all the share from Baba and hurt Baba. So I wouldn't say it's a permanent moat, but for now it looks pretty safe. But you do have to keep an eye open for real competition if you're going to invest in something like this. I should also mention, while we're talking about investing, this is not investment advice. It's just me. I actually am not even an expert in this. I just started reading about this like a couple of weeks ago. So take this all with a grain of salt and dig in yourself. So there's a few ways they can get the margins up, because that's the key here, right? They can specifically, one of the big things they can do is take more of their trucking in-house. They say they get about a 20% cost benefit when they do take it in-house, and they have about half of the fleet that still could be taken in-house. So that's one of the levers they could pull over time to raise margins. They also stopping, I forget what it's called. Is it DG Fresh? Yeah, so DG Fresh was a bit of a mess, and so taking resources away from that project can actually help with the margins, and and adding more. Basically, they can add more staff because I mean I've seen pictures of these stores, and there's shelves empty and there's stuff all over the floor because they just don't have the staff, and that also increases theft, right? If you're understaffed, people just grab stuff and leave, right? So the staffing is a cost, but I think it actually is a net benefit on the margin side, if I'm honest. And they're also adding district managers, because I think the district managers, what C2 wrote, that they're actually having problems because they're taking care of basically too many of the stores to do it effectively. So that's some of the ways they could increase margin. Now I should talk about the CEO for a second. So Todd Vassos is back. Jeff Owens was the previous guy. He was only there for a year, but he's essentially the fall guy here. Looks like he's being blamed for the mess, but I don't know how much effect you can have for after a year. But we do know that Vassos knows what he's doing, right? He actually had a great run prior to this, and he knows the winning formula. So, he's basically going to do a back to basics approach here and try and grow the gross margins. He forecasts that they can get back to above 10% growth rate on EPS on an annual basis. And if they can do that, you will see this stock re-rate. Now, I don't know how long it's going to take them to do that, but that's actually the winning upside. I should do another little side note here in that if the stock did re-rate, if I bought it, I haven't bought it yet, by the way. I'm still looking at it because I don't understand it well enough yet. But if it does re-rate, let's say it gets back into, where's my sheet? I've got to figure out. Let's say it gets back, into the $40 billion range, which is about a double from here. I probably wouldn't hold it after that, right? Because it's, I see it as a slow growing sort of stalwart with decent dividends. That's okay. I would recommend it for my mother to hold and keep holding, but I have a higher hurdle rate than 5-8%, 5 to 8% CAGR. So just keep that in mind. Basically, for me, this is not a compounder that I want to hold for a long time. I'm just looking at it as a re-rate option. The other benefit to it is that it's a bit counter-cyclical, or maybe a lot counter-cyclical. So if there were a economic-driven stock market crash, because there's actually a recession and it created a stock market crash, this could be an uncorrelated piece to a portfolio, right? Everybody knows that they'll probably do well if the consumer is generally squeezed and may see sales grow faster than this 4, 5, 6% rate, and could have a fast reversion to a higher margin level. I should talk quickly about growth here. So growth is primarily looks like available in Western U.S. They don't have nearly as many stores in the West. There's some stores in Mexico too. That's another potential growth avenue. But as an example, this is what C2 wrote, that California has basically 1/7 the stores per population versus a place like Texas. So potentially they could grow quite a lot in California based on the population there as well. So there's still paths to growth here. It's not just same store growth. They can remodel the stores, make them more consumer friendly, refine their SKUs, right? Add new stores and the same store growth. And I'm seeing that like maybe 5 to 6% per year, sort of for the foreseeable future. They are also paying debt down, so that's good, but I won't go into that here. Now, I guess maybe I'll talk about some estimates here. So let's look at these projections that I've just whipped up. Now, again, these are very quick, but just gives us an idea. Now I'm using a 12 multiple. This is lower than historical rates that they've traded at. And I think it's better to be safe here than expect them to go back to the previous level now, because if you're growing 5 to 6%, having a 20 times multiple on your stock, that's a big ask, right? So I'm going to use 12 just to be, because I think that's reasonable and it's somewhat safe. But base case here is they get back to about a 7% margin rate at some point. In this model, it's assuming it's happening this year, but and then the growth rate is around 6%. So those might be a little generous, but if they started to do that, I think you'd see a pretty quick double in the stock. If it took 5 years to 2028 for it to do that, it would still be a 17.5% CAGR just on the stock price. And then you add in another 2-3% of dividends, so you're around 20% CAGR, which is, nothing to sneeze at. That's a pretty good return. Again, I wouldn't hold it once it's re-rated. So on the low end, I'm going to use a really negative situation just to see what it looks like. I don't really think this is going to be the downside to it, because I don't think it's going to go to an 8 multiple and just stay there. They're going to have good days. They're going to have good quarters, good years, and it will pop up here and there, right? So, but this is just, let's be ultra conservative. Let's say the growth rates stalled out at 4%, margins stayed around 3.5%, and we got an 8 multiple on that. If you held this for 5 years, your CAGR would be negative 7%. Then again, add a little bit of dividend in there. Let's say you get a 2.5% dividend, and your CAGR goes to, what's that, 4.5 kind of thing, 4.6, negative 4.6. So I would say that's the negative situation. In a good outcome, margins get back to where we saw them previous to COVID, 9%. I would say this is probably a long shot, but could happen for a year or two in a recession situation, or maybe Vassos really gets the thing ticking along. It's possible. So growth rate up to 7.5%. I don't want to aim higher than that. And in those situations, you'd see a 25% CAGR over 5 years. And again, much bigger CAGR if it happens quicker. Like if we get a recession next year, you get over 50% CAGR. So I would say that this is a reasonable bet. I don't think the downside is zero here. I think this is a very entrenched business that is part of the fabric of the United States consumer at this point. Again, it could be the unknown risk of a competitor coming up with an even better model. Maybe cheap drones are flying everywhere, delivering stuff to people super cheap. I don't know how that would happen. Delivery is pretty expensive no matter how you cut it. Who knows? Or maybe Walmart comes in and just basically does a scorched earth policy, and they just compete directly with Dollar General and destroy both of them so that they can be the one that survives. I don't know, just an idea. But I do think it is a pretty stable business that we shouldn't think the bottom's going to fall out. So if you enjoyed that, check out that write-up by C2. If you got anything from this, hit like, hit subscribe, all that kind of stuff. If not, hit the thumbs down. Doesn't hurt my feelings. All right, guys, thanks. Catch you in the next video.